So, Berkshire Hathaway just dropped its second quarter earnings for 2025, and man, it sent some really confusing signals to investors. On one hand, you had a number that looked like a total disaster, but on the other, a story of incredible stability. So, let's break down this tale of two profits. All right, so this is the number that was plastered everywhere, a shocking 59% plunge in net profit. Now, when you see a figure like that from a company as legendary as Berkshire, you can't help but stop and ask, is this a sign of trouble? Is this huge fortress that Warren Buffett built over so many decades finally starting to show some cracks? It's the first thing on every investor's mind. What is really going on here? Okay, let's really get into it. To figure out what's actually happening, we have to look at two totally different profit numbers at the heart of this story. One caused on the panic, and the other tells us about the health of the actual businesses Berkshire owns. And here you have it, the two stories side by side. On the left, there's that scary headline number, net profit down a massive 59%. But then you look at the right, and that's the number Warren Buffett himself always tells you to watch. Core operating profit. It was down just 4%. In fact, it actually beat Wall Street's expectations. So what is this number really? Think of operating profit as the cash coming in from the actual, day-to-day grind. It's the money Berkshire makes from its railroads, its insurance companies, its energy utilities. This number separates the health of the businesses they actually run from the wild up and down mood swings of the stock market. It's the real heartbeat of the company. Right, so here's the key takeaway. That scary 59% drop, it had almost nothing to do with how their businesses were actually doing. It came from two main things. First, a huge 90% drop in paper gains from their stock portfolio. And second, a big one-time write-down on their Kraft Heinz investment, which is basically just an accounting move. These are paper adjustments, not signs that the businesses are failing. So, if the core businesses are humming along, what's actually happening under the hood? Let's take a look inside Berkshire's massive and really diverse engine room. And wow, this chart right here just shows you the power of Berkshire's diversification in action. You can see the earnings are spread out all over the place. The manufacturing, service, and retailing group was the star of the show. Their strength basically carried the team, making up for a softer quarter from the insurance side, which took a hit from things like the Southern California wildfires. And if we zoom in a little bit, you can really see that dynamic. BNSF Railroad just crushing it, with earnings up 19%, thanks to more freight moving around. The energy business also saw solid 7% growth. This strength helped cushion the blow from the 12% dip in insurance profits. It's a classic Berkshire story. Different engines, firing at different times. Okay, so profits aside for a second, there's another number in this report that has everyone talking and asking one giant question. $344 billion. That is how much cash Berkshire was sitting on at the end of the quarter. It's a mountain of cash, a massive war chest just sitting there, ready to go. But this also created a bit of a mystery. So here's the mystery, right? You've got all this cash, your stock price is down more than 10% from its peak. So why on earth did Berkshire stop buying back its own shares? Well, the folks who follow this stuff closely have a couple of really smart ideas. And here's a great take from an investor on Reddit that kind of nails it. It all boils down to valuation. Buffett is famously disciplined. Even though the stock fell, it was probably still too expensive by his favorite yardstick, which is called price to book value. For Buffett, it just wasn't a bargain yet. Simple as that. And, there's another layer to this. Another investor brought up a really good point. There's a new 1% tax on share buybacks. So that adds an extra cost and just makes it even harder for the numbers to work. The stock would have to be an even better deal to make it worth it. So really, pausing the buybacks isn't a sign of weakness. It's a sign of that classic Berkshire discipline. It shows that even with a big leadership change coming, the core principles are still running the show. And that brings us right to what's next for the company. I mean, think about it. This company started as a failing textile mill in '65 and became an absolute juggernaut through these huge game-changing deals. But now, it's facing the biggest change of all, as Greg Abel gets ready to officially take over as CEO at the end of the year. This is about who gets to decide what to do with that mountain of cash. And look, this new era isn't without its hurdles. You've got potential tariffs that could hurt their businesses. You've always got the risk of a massive hurricane or wildfire. The stock market being, well, the stock market. And of course, the big question of the leadership change itself. This slide, honestly, this sums up the entire debate perfectly. On one hand, you use a classic conservative Buffett-style model, and the stock looks like a hold. It's fairly priced. But if you lean into a growth model that focuses on earnings power, it looks like an absolute screaming buy. This is the exact tug of war that investors and the new leadership are dealing with. And so that leaves us with the big one, the multi-billion-dollar question. With a new leader taking over and that staggering $344 billion war chest just waiting, what is Berkshire's next move? The whole world is waiting to find out.